Hi there. Now this week's video is going to be slightly different than my recent videos in that we're going to be talking about the actual markets, the recent moves that we've been seeing. I think it's important that you know why these bigger moves in the global stock markets can be very good for us as Forex traders, especially if you know what you're looking at. Now, before I continue, let me remind you to subscribe to the channel if you don't already do so. Make sure you hit that little bell notification. That way you'll be notified the moment my next video has been released. Also, you can follow us on Instagram and of course Facebook. And if you follow us on Facebook, you can join me live every Monday at 2 p.m. London time, where I stream live absolutely free of charge, discussing the trading opportunities for the week ahead. Also, at this juncture, I want to say that the views and opinions in this video are purely my own. They should not be considered as investment advice. As always, please consult an investment advisor before investing in any money or any trading instruments that you are unfamiliar with. Just the usual disclaimer, because today we're talking about markets. So, what caused this stock market sell-off? Well, like most things in trading, it's easy to talk in hindsight, but I guess looking back, the writing really was on the wall that a major correction was due. But as with trading, it's all about timing. It always is. And I'm going to be the first one to admit I didn't pick the top of the stock market there at 27,000 back in the beginning of October. The reason why it dropped so rapidly, so fast, I think can be discussed from 2 points. The first point I think is significant is what was happening to the US bond market. Now, any of you that follow the economies of the world would know that the US economy has been growing at a healthy pace more recently, up to almost 4%. But the problem that central banks face when the economy is growing so fast is that they have to control inflation. They've got to keep a cap on inflation. That's what they're mandated to do. And in order to control inflation, to contain growth, they've got to move interest rates. And that's exactly what the Fed have been doing. Now, if the economy were to grow and the Fed were not to contain interest rates, then inflation could end up out of control, which is very, very damaging. So the Fed have been moving interest rates, as I've said, and they're also scheduled to move interest rates again, maybe for the rest of this year, one more time, and possibly 3 or 4 times out into next year. Now, the US Treasury bond market was catching up. It was reflecting these interest rate increases. Just before the global stock market fall off, the US 10-year Treasury hit almost 3.25%. Now, the 2-year deposit rate was up at 3%. Now, when yields got to this level, I think there was a significant shift in the real money out of stocks into the safer bonds. And it's, guess, no real surprise. If, after all, you're able to get a guaranteed 3% for tying your money up for just 2 short years, it does become quite an attractive proposition, certainly for pensions and funds and the like. So then there was a big selling of stocks and the move into the Treasury market. Then you saw a drop of almost 1,000 points, I think it was, in one day, and it got some investors nervous, seeing all their juicy gains that they've had over the preceding months wiped away, and it was a bit painful. And others then started thinking, okay, I don't want to lose any more. I want to lock in my profits now, and they started selling as well. And the number 2 reason, I think, or catalyst for the stock market drop was likely to be the trade tensions building up around the world, with the US and China fighting it out on a daily basis with tariffs and so forth. Now, this has resulted in a real slowdown of the global economies, in particular the Chinese economy, which, as you know, is the second biggest economy in the world. Now, if China slows down, generally affects commodity prices. They get affected as well. A slowdown in China could lead to a global slowdown, and that's obviously what the markets were thinking. And if the economies around the world are slowing down, then it's time to move out of the stock market, and that is exactly what was happening. So how does the Forex market get affected when you see this shift in money out of stocks? Well, firstly, let me say this. It's all about risk on, risk off. Stocks are considered more risky, so they are risk on. Now, when there's a move out of stocks, that's a move to risk off. Now, risk off generally sees the safe haven currencies, such as the Japanese yen and the Swiss franc, benefit. There's a move into those currencies. So why do these currencies benefit in times of risk off? Well, these are low yielding currencies. Japan and Switzerland have negative interest rates. So rather than keep your wealth in a currency that has a negative interest rate, it's better off to buy global stocks. And if you want to buy global stocks in a foreign country, you first, of course, need to buy the currency of that country. And then you'll be selling the yen and the Swiss franc against that other currency. Now, if the reverse were to happen and stocks start going down, then the money is moved out of those foreign currencies and repatriated back into the Japanese yen and the Swiss franc, the low yielders. Remember, this is not an exact science. Markets are living, breathing entities and don't always behave as they should, but this is a basic rule of thumb. So when stock markets are growing and expanding, it usually means that the economies of those particular countries are expanding. And if a country is expanding, that basically means more factories are being built, more plant is being made, more machinery is being built. So that generally means the commodity prices rise. When commodity prices are in demand, countries such as Australia, which produce iron and steel, New Zealand, Canada, these are known as the commodity countries. These currencies should increase in value. Again, this is just a basic rule of thumb. Now, you may have heard that expression in the past: when the USA sneezes, the whole world catches a cold. Well, it's pretty true. When the US stock market drops, the whole world pays attention, and so it should. So, basic rule of thumb: if the US stock market, global stock markets, were to continue to fall, you could see a drop in the commodity currencies like the Australian dollar, the Canadian dollar, New Zealand dollar, and so forth. You could see a rise in the safe haven currencies such as the yen and the Swiss franc. Now, it does really open up some great opportunities for us in the Forex markets, which is why we're always looking at the global stock market as well. With the use of controlled leverage, trading the Forex market can turn your bad losses in stocks into a nice profitable gain somewhere else in your portfolio. Look, I hope you found this useful. I hope you found the video interesting. Give me a thumbs up if you did. Give me a thumbs down if you didn't. Don't forget to leave a comment. I try to get back to as many as I can. Of course, as I said, don't forget to subscribe to the channel if you haven't already done so. That bell notification will get you notified the next moment my next video is released. And also follow us on Instagram and Facebook. If you follow on Facebook, I'll see you next Monday, 2 p.m. London time. Till then, happy trading and goodbye.